Hi, this is Tim Horning, and this is Tuesdays with Tim. I'm the Real Estate Educator. This is video number 13. My topic today is how to calculate your annual benefits from your residential rental properties, from cash flow, principal paydowns, and tax savings. This is important because you need to know what that annual investment is doing for you each year that you own it. With the soft market and with interest rates so good, going out and finding those properties under market and buying them for the cash flow is so important. Most important point about owning a residential real property, of course, are the things that we've named and we've been covering over the past weeks. You can basically acquire your property. You can't write off the expense of your everything that you pay for it. However, the government does allow you to depreciate a portion of the property. You have a residential rental, you're either going to report it on Schedule E or on Schedule E page 2. It may flow through an LLC, a limited liability company, which is normally what we recommend how to hold the property. On your screen you'll see an example of a scenario that I have showing a cost of $350,000 with $70,000 down. You'll see the rest of the the facts in the example on the sheet. Please print that out so you can use it in your specific analysis on property that you may be buying or property that you currently hold. You need to calculate both your projected cash flow and also your taxable income when running these figures. You'll see that the main difference between the two is that the principal portion, it's part of your cash flow, which is part of your mortgage payment, is not deductible. The interest portion only is deductible each year, but you make up for that by having the depreciation. The allocation of the depreciation is you have to allocate a portion to the building, which can be depreciated over 27.5 years, a portion to the fixtures, which is depreciable over 5 to 7 years, and then you allocate the portion out for the land, which is not deductible because it's the land Katie. It's the only thing that lasts. So there's no expense that they give you, which is real sweet because you've got an asset that if you take care of, including the building, the structure, you're able to still expense. You expense, of course, the repairs and maintenance, but you're also able to expense a portion of the original cost that if you take care of that property, it's actually going to appreciate in value. So the government does give us a break on that, which helps on the annual cash flow. After the facts that are shown in the example, you can see where the projected cash flow is about $4,696, almost $400 per month. The tax savings that I've listed there is because in that second column, which shows the taxable income, you do end up with a loss, and then the tax savings on that loss are shown there. It's not a huge number, but remember, you're also able to shelter the $4,696 of cash flow because that is not currently taxable. So that's an annual benefit that adds to your overall benefit per year. And you can see then down at the bottom it shows with the cash flow, the tax savings, and the principal paydown, which adds to your equity, you actually have an annual benefit of $9,668. Not bad for an investment of $70,000, which is sweet. Now there are some disclaimers there because if you have total rental losses of over $25,000, the rest of those losses are not currently deductible. They have to be deferred to future years. Also, there's other things that impact this. There's passive loss rules for the income. When your income is in the higher amounts, over $100,000, they start limiting it. Over $150,000 is kind of the key. Then you also end up with some alternative minimum tax issues. But these are things that you'd look at in your individual scenarios. In conclusion, remember that the owning residential rental property benefits you each year, and you need to understand what that is in looking at your overall wealth building plan. In future weeks, we'll be talking about some techniques to deal with the rental property when you want to sell it or exchange it, because you can use Section 1031 exchanges to defer the gains into future properties. There's also some estate planning that can be done. Now, right now, there is, we still have the capital gains rates, which is a nice benefit. How that will work in the future, we don't know, because that may change. under the current administration or the future administrations. Check this each year. Look at how your annual wealth plan is doing overall, and think with the end in mind when you're looking at any residential property that you acquire or that you currently own. This is Tim Horning, and this is Tuesdays with Tim. Keep the calls coming. Have a great week.